Welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions so you can be more confident in your own financial future. We're going to cover some key opportunities and risks for investors tied to developments around the world, certainly sprinkling a lot of tariffs today. And we'll take your live questions from the chat on YouTube, so you can ask us what's on your mind at any time by entering again the chat, and we'll get to those questions in a few minutes after we share some of our latest insights. Now, we've got a few required disclosures before we get started. We don't know you personally, so we don't make personalized recommendations. We talk generally about the markets and the sectors and the areas of investing we think are likely to perform well or poorly and why. And of course, things can and do change, so all our thoughts we share are subject to change as well. And investing has risks, and international investing has unique risks like currency moves, so please keep all that in mind. Now, Michelle is on vacation today, but as is the case every week, Heather O'Leary on the global strategy team here at Charles Schwab is with me this morning. Good morning, Heather.
Good morning, everybody. As typical, I'll be watching the chat and your questions very closely, and we will get to those in a little bit. Jeff, can you go ahead and kick us off with a quick rundown of what we're watching this week that could move the markets?
Yeah, sure, Heather. It's another big week. So after a spring break from some of the tariffs was announced by President Trump last week, trade developments are still going to be front and center this week. Chinese President Xi Jinping is expected to visit Vietnam, Malaysia, and Cambodia here today and in the coming days as Beijing looks to strengthen its ties with some regional partners. There was some deals signed with Vietnam this morning. On Wednesday, China is going to release its first quarter GDP data, always one of the first countries to release its GDP. It's at best a guess at what GDP was actually in the first quarter, but they're going to release along with it the March data, all their activity data, and that comes amid mounting concerns over tariffs. And of course, the World Trade Organization is going to release its global trade forecast this week as well. That's coming on Wednesday, so we'll be watching that carefully. And then on Thursday, the Italian Prime Minister, Giorgia Meloni, she's going to discuss EU tariffs with President Trump at the White House. So there'll be a lot going on the tariff front this week in terms of economic forecasts, in terms of meetings and negotiations taking place, and then a lot related to China in terms of its data and how it's shaping up. It's also a big week for central banks. On Wednesday, we're going to get the Bank of Canada's rate decision. Most economists are expecting no change in rates, although several others expect a quarter-point cut, so we'll be watching that carefully. Thursday is the meeting for the European Central Bank. We do expect a rate cut there, 25 basis points, bringing rates down to 2.25%. Amid all the tariff turmoil. Interestingly, while the U.S. is risking inflation on the back of tariffs, most of the rest of the world is seeing a disinflationary impulse from tariffs. And we continue to see inflation, including services inflation, easing and remaining fairly low and stable around the target rate of 2% in Europe. So continuing those rate cuts. Also on Thursday, the Bank of Korea's rate decision will be formulated around tariff uncertainties affecting that country. And after analysts have been lowering their earnings forecasts in recent weeks, we are now really officially kicking off the earnings season. We got some financials reporting last Friday. We're going to hear more from them this week. We've got 33 major global companies scheduled to report and provide insight on their outlook amid all the tariff-related uncertainty. Today, we got Goldman Sachs, we got Citigroup and Bank of America earnings tomorrow. On Wednesday, we get semiconductor capital equipment maker ASML. It's a Netherlands company, very important company making the equipment used to make the chips for NVIDIA. We've got the chip maker TSMC that makes the chips for NVIDIA on Thursday, and they're going to give us the latest read on the AI chip outlook. And that's interesting because today we're seeing a lot of those names rally. I'll talk about a bit about why in just a few minutes. But then at the end of the week, the markets are going to be closed on in the U.S. here for Good Friday, and a number of other markets around the world. So that's what's coming up in terms of things that could move the markets day by day. Of course, the overarching theme is tariffs, and last week was wild. We had the reciprocal tariffs applied for 13 hours before they were delayed. That was 1.4 times the 9 hours that those 25% Colombia tariffs were applied earlier this year before they were lifted, but only 0.27 times the 48 hours tariffs were applied to Mexico and Canada before they were lifted on USMCA goods. Look, I joke around a little bit because it's just so hard to make investing decisions in an environment where huge tariffs are applied for 9 hours or 48 hours or 13 hours and then rescinded and radically changed. It's just, you almost have to throw your hands up a little bit. And that's why we continue to say, be careful trading headlines here. Think a bit longer term, and we'll help you with our show here today, as we have all year, talking about where we think tariffs are headed and what it means for various parts of the market. Our base case that we began to talk about in December of last year was that this year's Trump tariffs would be bigger than most investors expect, but that then would be dropped or reduced quickly. And while the tariffs would likely rise over the course of the year, they wouldn't be enough to cause a global recession. So far, that is turning out to be the case over and over again. But it doesn't mean they're all gone or that the risk of recession is negligible. We still have the 10% tariff in place across the board, applying to most countries, and the high tariffs on China in place as well. But the tariff exemptions announced this weekend, reported by the Customs and Border Patrol, on various electronics goods, smartphones, semiconductors, electronics, TVs, represent a partial de-escalation of President Trump's trade war with China. The 20 product types that were included in the notice that are now exempt from that 125 reciprocal tariff account for about 23% of U.S. imports from China. So it's a big chunk. And there were even bigger winners in Asia, since the exemptions apply not just to China, but to all countries. So with that one action, 64% of U.S. imports from Taiwan are now exempt from Taiwan's 10% reciprocal tariff. 44% of the imports we get from Malaysia are exempted, almost 30% from both Vietnam and Thailand, and around 10 to 12% from India and Korea, also going to be exempt. So emerging Asia, remember last week I said, was set to be hit hardest by the reciprocal tariffs, but not anymore. The upshot is that the effective weighted tariff rate on imports for many of these Asian countries is now just 4 to 9%, while the effective increase on China after the exemptions are accounted for is now closer to 106. Still a huge number, but very different than the 125 or 145 that have been talked about. Now, they probably won't be the last exemptions either. We've got the success of Apple's Tim Cook in getting its smartphones exempted as he lobbied the White House. That's likely to be copied by other actors and other sectors as well. So there might be other exemptions. But today is certainly seen as a short-term win for the U.S. tech champions like Apple and NVIDIA. We can see that in the stock market move today. Many of those Mag 7 names, among others like Dell and Intel and Micron, are really helping to lead the gains in the U.S. stock market today in the S&P 500. But Trump and his top aides on Sunday declared that the reprieve was only a procedural maneuver to ultimately hit those tech products with a different sector-specific tariff soon. Now, we've long been talking about on this show the coming semiconductor and pharmaceutical sector tariffs that are likely to pop up. Remember, those two areas were excluded from the quote-unquote reciprocal tariffs, and we've been expecting them for some time now. And looks like that's what we're on track to see. So while these were electronics were kind of set aside, the thought is that very soon we are likely to see tariffs on semiconductors and maybe everything related to electronics that use semiconductors. So this drop in electronics tariffs may only be short-lived. For business leaders in countries sending negotiators to Washington, like the European Union's trade chief is aiming to do today, and Giorgia Meloni, Italy's prime minister, is expected to do on Wednesday, you got to wonder whether talking is even the best approach while tariffs are still changing seemingly every day. Or maybe it's the best approach while they're changing every single day. I don't know. But it certainly sets us up for more volatility this week in different sectors, particularly tied to technology. But let me get back to the big picture again, because I think this huge tariff on China has interesting implications as well. It's so much bigger than what we see in other countries now with the 10% tariff, or now, as I mentioned, 4 to 9% tariff on a bunch of other Asian peer countries that also produce a lot of products that we used to get from China. So talking about the big picture, we've got this 145, 125, 106% effective tariff for goods on Chinese exports to the U.S. The incentive to find ways around that wall is strong. And one way is by transshipping from China via Vietnam and paying a much lower tariff rate, something that data shows China's been doing increasingly since 2018. I didn't put the chart together for today. I've showed it on the show many, many times. The products that we're getting from Vietnam have ramped up since 2018. The same products that we get from China have fallen down. It's almost a perfect offset. Clearly, Chinese manufacturers have been shipping through their subsidiaries or just through Vietnam ports. So that's one way to get around the tariffs. That may continue. That may mute the impact of the Chinese tariff impact on U.S. goods. Another way is to under-invoice the value of Chinese goods. The incentive to do that is now overwhelming, and that could widen the distortions in China trade data. Look at this chart. I put this together over the weekend. So take a look at this. This is what the U.S. says it's importing from China, and what China says it's exporting to the U.S. Now, it used to be that the U.S. Reported imports from China were higher than what Chinese companies said they were exporting to the U.S. Now, that has to do with the change has to do with the first rounds of the Trump tariffs on China in 2018 and 2019, which were maintained and then widened under Biden. Since then, the value of imports claimed by China has gone from being above what the U.S. claims, over invoicing to get money out of China, right, to being more than 100 billion below, under invoicing to avoid tariffs. But you might raise the question, well, wait a second. If this is now, the incentive to do this is now much wider, and we see these two lines move further and further and further apart, meaning, what China says they're exporting to the U.S. versus what China, what is declared as being coming into the U.S. widens and widens. Won't the companies making false trade declarations get caught? That's pretty unlikely. I'll tell you why. Some basic math here I did. So if you look at the Customs and Border Patrol number of import specialists at ports who are responsible for classifying and appraising commercially imported merchandise that enters the country, they likely number a little over 1,000. I could be wrong since the numbers aren't published exactly, but I'm going off some of the older info on the Customs and Border Patrol website where they numbered about 990. So going off that assumption, since the ports of Los Angeles and Long Beach by themselves will process about 115,000 20-foot equivalent units this week, the big containers, much of it on the most popular route from Shanghai to LA, with about 70 ports in the US. There might be 310 specialists at that port if you just weight it by the port volume for LA. So you've got roughly 1,000 of import specialists, so call 310 of those at LA and Long Beach. That's about 50 containers per specialist per day. Now, even just a high-level inspection by X-ray and reconciliation against the shipping documents probably takes at least 15 to 20 minutes, with a physical inspection taking at least an hour. So there's not 50 hours in a day. So it seems to me that the Customs and Border Patrol is under-resourced to evaluate the incoming shipments to avoid widespread under-invoicing for tariff avoidance. So why did I just go through all this for the last 2 minutes for you? Because while I think there's some risk of recession in the US and elsewhere, the risk is mitigated by these types of tariff exclusions. 99% of the stuff coming into the US is probably not going to get reviewed, and it could certainly be under-invoiced and not pay those full tariffs. So all these avenues of avoidance, I think, could mean the actual impact is a little bit more muted than what we're seeing, right? Because of transshipment, because of under-invoicing, we may not see quite the same impact on the US or other economies that it would seem on the surface. And that's why I want to take with a grain of salt some of the numbers and some of the data we're seeing in terms of the outright impact on money raised by tariffs, or the impact on inflation, or the impact on the economy, because there are so many routes to avoid paying these high tariffs unless we see a just massive change in the staffing of the CPB, which we could, seems unlikely, but we could. A lot of those factors could be mitigating this. Another thing I want to talk about today, to just ramble on here, is a notable feature of the recent sell-off, and that's that U.S. safe havens have failed to rally. Usually, in a global growth scare, the dollar and treasuries typically rally. And this time, during the sharp sell-offs in the stock market, they've not. Treasuries fell along with the dollar. Very unusual. And that's dynamic reinforces concerns about an accelerating rotation out of U.S. assets, stocks, and bonds. At the peak of the U.S. stress, Treasury yields rose and the dollar fell, while the euro rallied and the German 10-year bond yield fell, which means the 10-year bond price went up, right? So German bonds rallied, the euro rallied, U.S. Treasuries sold off, and the dollar sold off. And that tells me we're seeing safe haven demand shift to Europe. And we might be entering a win-win regime for the euro and euro assets. They act as a safe haven when U.S. uncertainty spikes, but they also benefit when global growth strengthens, since European stocks have also outperformed not just this year, but also fell less and rebounded more during the wild swings we saw in April. So the euro and euro-based assets are outperforming on the downside and on the upside. The dollar's down. Let me look at my screen. 8.2% so far this year. The euro's up 9.7% so far this year. That's not what's supposed to happen when a country adds import tariffs. The euro is up sharply this year, like I said, about 10%. Now, we remain positive on European stocks, as we have all year, even after the 18 percentage points of outperformance of the S&P 5, by European stocks of the S&P 500 year to date. It's been massive. We still think it can grow from here. One risk to the markets overall this week, though, is earnings. We are now kicking off the earnings season, and the guidance might be weak. Business leaders do not have a clear view of the operating environment due to the on-again, off-again nature of the tariffs, and the earnings outlook is suffering from cuts. In fact, every week this year, analysts have been lowering their expectations for earnings from S&P 500 companies, with the pace accelerating recently. You can see that that's all the blue columns on this chart. This is the sort of net revision index for the US, orange is for Europe. You can see all this year, blue, 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 every single week, the net revisions have been down by analysts for US stocks. But in the green box there, you can see European companies for much of this year had seen upgrades to their earnings forecast, but not the case over the last 4 weeks. We're seeing downward revisions both in the US and in Europe that could continue this week as we get into the earnings season. And that's unusual because typically once we get into the actual reporting season, earnings revisions to estimates are usually up. Companies usually beat estimates and raise their outlook. But this season might be an exception. Just because of the tariff uncertainty. I can't see a lot of businesses out there feeling really confident, crushing their numbers and raising forecasts, right? It just seems like we may not see that. And with tariffs on a delay, and the uncertainty around that, earnings may be the focus of markets this week, and it could be dominated by lower estimates given the large share of sales subject to tariffs for many global companies that dominate the indexes. And that's why we continue to emphasize companies with more domestic sales exposure. This theme continues to work day in, day out this year. We talked about it all year. Using the Goldman Sachs baskets of companies screened based on their sales exposure. So Goldman on Bloomberg puts together these baskets of stocks. They basically just screen for companies, in this case in Europe, it's working in the US as well, but clearly in Europe, companies with more domestic sales relative to international sales continue to outperform consistently on both up and down days, because Europe's outlook is just much brighter than the US. You can see it in this chart of the performance of companies with more domestic sales divided by those with more international sales. The gap is now 14 percentage points, since the more domestic focused companies are up 18% this year, while more internationally focused companies are up only like 4 or 5. For reference, the S&P is down about 9% so far year to date, at least through Friday. So that's what's going on here in terms of investment themes, still focusing more domestic-oriented stocks, still like Europe and euro-based assets over the US. And turning back to China, let me just talk a little about what they're doing to boost domestic growth. Their stock market's up a lot this year. Let me talk about what this is all about. Trade with the US obviously may suffer for China. I know I talked about all the ways to get around tariffs, but still, overall, the 3% of China's GDP tied to direct sales to the US could certainly suffer. Recall that about 40 to 50% of China's GDP comes from consumer spending in China, and only about 3% comes from direct exports to the US, with maybe another 3 to 5% coming from indirect exports to the US. So you can see that shift. Maybe the 3% of direct exports drops a bit, and the indirect exports to Vietnam and other places goes up a little bit. And maybe the under-invoicing causes those numbers to shift a little bit. But clearly, domestic spending is more important to growth in China. And if they can boost it meaningfully, it can more than offset falling US exports on overall GDP. This chart that I put together this weekend shows that China's GDP growth was around 5% last year, give or take. That's what it was officially reported. Most of the indicators I watch, non-official indicators, are pointing to a relatively similar number as well, maybe a little bit below that, but close to 5%. But most of that was exports, the green, not consumption, blue. So if the blue can rebound this year, let's say getting back to where it was in 2023, it can offset that slide in the green. As that green squishes down a bit, maybe the blue can rebound. That's the plan. Anyway, China has 3 budgets. Combining all of those, we get a plan to boost spending, a deficit spending of 11% of GDP this year. That's a record. You can see it in this chart here. This is the total amount of spending relative to GDP. They're negative numbers because it's a deficit. You can see where it's coming from, the different components of the budget. But this is bigger than the pandemic spending in China, where they just huge amount of spending. So really, they're kind of pulling out all the stops and planning a lot of spending. But as I've said many times on the show, China has a history of over-promising and under-delivering on stimulus. So we need to watch to see if this actually happens. This is what they plan to spend. Are they actually going to spend it to boost the economy? So far, we've got January and February data, and they weren't that much greater than last year in terms of government spending. So we aren't yet seeing the full-scale stimulus begin to be enacted just yet. But that's not a big surprise. Michelle has been saying all this year on the show, they were likely waiting until we saw what happened on April 2nd. And so now that they know, we'll be able to look at the data as it comes in for April and May as it gets reported in the coming months to see if China's turning around and really starting to ramp up stimulus. That could be a real positive for emerging market stocks, from those in China to the rest of Asia, which key off of China's growth, to Latin America. I mentioned last week on the show how Brazil is much more tied to Chinese domestic economic growth than U.S. economic growth. They sell more to China than they do to the U.S. So a lot of the world's emerging markets really keying off of China's growth trajectory, and we just don't have data on that yet. They're planning a lot of spending. Do they deliver? We'll only know that when we start to get the April data, which we'll only begin to get in May. So we're still a bit away, a month or so away from actually getting that data and feeling confident that the Chinese economic growth may offset the slowdown in the U.S. for the world's emerging market economy. So we'll keep a close eye on that and keep you informed. All right, enough from me. A lot of talking today with Michelle not on the show. Heather, let's turn it over to you. What are we hearing from the chat Q&A?
Well, one of the first questions we have is regarding market valuations. U.S. markets have been very expensive on several metrics. And with the drop that we saw last week, are the PEs getting any better? What's your thoughts?
Yeah, so while I'm talking, let me pull up what the latest numbers are here in terms of forward estimates through this morning for the U.S. stock market. We've seen U.S. stocks come down. Unfortunately, as I mentioned, we've seen earnings revisions come down too. And since valuations are generally the price divided by forecasted earnings, they're both falling. Maybe not quite to the same degree. I think valuations falling a little bit more than earnings, but you get the point. They're both coming down. That's kind of maintaining that overvaluation for U.S. markets. And I've got a little error here as I'm pulling up the data. That's never a good sign, but I'll pull it up for you here. I think PEs for the U.S. are still around 20 times earnings or a little bit higher, well above their long-term averages, and still a huge premium over Europe. We're talking about a 40% price earnings multiple premium to that of international markets. And here it is. So let me just get it for you here, the latest numbers. So we're looking at 19.3 as of this morning, so still around 20 times earnings, and well above the roughly 13 and a half we're seeing for international stocks. There's naturally a premium to US stocks over international simply because of the sector differences. A lot more healthcare and tech in the US stock market. Those are sectors that have higher PEs, a lot more energy and financials in Europe or international markets, which naturally have lower PEs. But even if you adjust for that, the premium is the widest it's ever been between US and international, and particularly Europe stocks. Europe dominate the international markets. They make up, 50, 60% of the international market cap. So I tend to just focus on that as a region. But it's a big wide gap, and particularly even companies within the same industry, you'll see a big gap. I'll just pull up right now. This is just for illustrative purposes. I don't have a view on any of these stocks, but let me just pull up really quickly. Coca-Cola, classic U.S. stock in the consumer staples space. The forward PE on 2025 earnings, 24.35% as of this morning. And Nestle, a company that also sells beverages and snacks to the rest of the world, right? Very similar customer base and global operations to Coke, trading this morning at 19 times forward earnings. So a big gap, right? These are two companies with essentially the same revenue outlook to the same customer base, selling roughly the same beverages and snacks. The U.S. company is trading at like a 20% premium, 25% premium to the Swiss-based, the European-based company. And that isn't always the case. Usually those have a PE that's right on top of each other. So U.S. stocks still appear to be, even if you drive down to company-specific comparisons, at a very substantial premium to international stocks. So what is the outlook? I think that gap continues to narrow this year. It's what we've been talking about, seeing that valuation gap narrow. At the same time, maybe European companies' earnings estimates remain a little bit more stable than those in the US. There's maybe a little less uncertainty around them, since Europe's in a trade war with one country, the US is in a trade war with every country, and the consequences of that are probably a little bit more on the downside for US multinational firms than international multinational firms. But we'll have to see. Even if they move at the same pace, meaning earnings estimates for international and U.S. companies fall at the same pace, valuations provide much more support, given they are actually slightly below their 20-year average for European and the rest of the international marketplace, whereas in the U.S. they are well above still. So that's my thought on valuation. They are offering more support and opportunity for the upside here for international stocks than those in the U.S. Long answer, but a smart question.
Thank you so much, Jeff. There is a little bit confusion about the invoicing that you were discussing earlier, with China over-invoicing and then perhaps under-invoicing. If those numbers don't quite match up, what is the impact for inflation, as well as who might actually bear the burden of the tariff?
Interesting question. So essentially, if the U.S. importer is able to pay a lesser import tariff because of maybe the under-invoicing of the products that are coming in, maybe they're valued at less than what they might actually be worth, then maybe there's less of a tariff impact on the cost of getting those things into the U.S., and therefore less that the U.S. importer will have to pass on to the consumer or eat in terms of their profit margins. And so maybe there's a lesser inflationary impact on some of those items. Hard to say clearly what that will mean. Obviously, when you're talking about, for some businesses, they import a lot from Asia, and so talk about and China in particular. So when you're talking about 100+% tariffs, it's hard not to pass those on to your customer. But if you could reduce those substantially, maybe you can pass on a little less of it. So the impact, my point is, take with a grain of salt the estimates you see in terms of how much revenue the tariffs might lift, inflation, how much those tariffs might lift on U.S. products sold to U.S. consumer, on consumer products being sold in the U.S. to consumers that have international components, and the like. It's just going to be mitigated a little bit by some of these factors. They are significant factors. This is not a rounding error. This is a big deal. You've seen, you're talking about already maybe 10 to 20% undervaluation of imports from China coming into the U.S. That's a big deal. And it doesn't mean the companies are paying less for the products. It just means they're likely paying less on the tariff. And so, but when the tariffs were nothing or 10% or even 20%, maybe that wasn't a big deal. When you're talking about 100% or more, it does begin to matter. So it's just a way for them to offset some of the increase. There's still going to be an increase in tariffs, and some of that may be passed on. You see companies like Five Below. You see a lot of other, retailers that really focus on Chinese goods being sold inexpensively to U.S. consumers, pulling their guidance, pulling some products off the shelves. We continue to hear that even through last week. That may happen, but just the impact might be to a lesser degree than what we might see otherwise. So that's all I'm saying. Just a lot. There's going to be more distortions to the data. It makes it harder for us to try and see what's actually happening. When we see a big drop in imports from China, as it's reported in U.S. import data, is that real or is it under invoicing? How do we know? We don't know. And so it's just going to get more and more complicated to try and filter through a lot of this data and really understand what's going on at a granular level and what it means for businesses.
Thanks so much, Jeff. I think we have time for one more short question. You talked about Europe as being a safe haven alternative to the United States. Do we see any markets in Asia that could also fulfill that role?
Yeah, so relative safe haven, let me put that out there. There are no winners, absolute winners in a trade war, but there could be some relative winners. I know you know that, Heather, but I'm just making that clear. We're looking at Asia. It's possible that there are some countries that could benefit from this. Look, specifically within emerging market Asia, it's India. India stands out as a country that has the ability to lower tariffs with the U.S. and therefore gain some concessions with the Trump administration. They've already done that to some degree on motorcycles and other products. They seem to be lining up there. It seems to be a safer destination than China for manufacturing. Apple's already moved some iPhone manufacturing to there. So India is somewhat of a beneficiary of some of what's going on here. So India can benefit in the EM space. And looking at Japan, 24% tariffs have been delayed right now, and they're a bit higher than 10% tariffs, but they are. Japan has a lot of incentives they can offer the Trump administration. Japanese car manufacturers already do a lot of production in the U.S. Way more Japanese cars are made in the U.S. than imported from Japan, and they can ramp up that manufacturing. They have the ability to scale that up as a opportunity to help the Trump administration achieve some of its objectives. There are other things Japan can do as an offset to Chinese influence in Asia. So I think Japan has the ability to cut some deals with the administration more so than others. Treasury Secretary Bessent has talked about Japan being at the top of the list of countries that they're looking to work out a favorable deal with. So that's great news. Korea, Trump had discussion with the leader of South Korea last week, said they have the framework for a quote unquote great deal with South Korea. So that could be another country. Remember, we get a lot from South Korea, a lot of big electronics manufacturers in South Korea. They're already seeing some exemptions now in those electronics tariffs. Maybe when they're put in place, they'll find some carve outs so that some of Korea's products aren't hit as aggressively by those semiconductor tariffs. Electronics tariffs, we'll have to see. But that's another country. Korea is an interesting one. In some indexes, it's characterized as an emerging market. In other indexes, it's characterized as a developed market. So a little bit, it could be in one index versus the other, depending on the ETFs that you're using. But I would say those three countries, India, Korea, and Japan, probably stand out in Asia as safer havens as we look at the tariff direction going forward. But let me say, I don't really know what's in Trump's head. This is all coming down to one person's decisions on this, and it's what he presented with and what he decides to go with at the moment. But from my vantage point right now, those countries seem better positioned than many others to help achieve the objectives of the Trump administration and perhaps receive some benefit on the tariffs as a result. So thanks for those questions, everybody, and thanks to Heather and our producer, Andrew, today. Gabe is enjoying his sabbatical. Have a great time, Gabe. And everyone, for the questions and for joining us. Tune in each week at 11 a.m. Eastern or catch the replay on YouTube. Also, be sure to click like on the show and share your comments on what you're watching in the markets. And we'll see you again next week.